How's it going, everyone? Welcome back to the channel. In this video, we're going to be talking or addressing something called the silent US retirement crisis. Now, recently on the investing website CNBC, a BlackRock CEO came out and he warned of this silent US retirement crisis. When he's saying this, he's addressing everyone who's working hard for their money, saving their money, putting it away in the bank, and thinking when they reach 65, they're gonna be able to sit back, drink martinis by the beach every day, and enjoy life and live off their savings account. This is a warning to all of you guys. So let's see what he has to say.
You just said that if inflation's probably going to be higher. They're stuck in this box where they can't really stop, and the more they don't stop, the more savers get hurt. So what's the answer long term?
Joe, I think you framed it really well, and I've been talking about that for years. About the silent crisis of a retirement, and unquestionably, as central banks keep rates low or negative in Europe, the savers are getting slammed. And you're absolutely correct. Asset owners are the biggest beneficiaries of monetary policy, and this is why.
Wait, I just want to quickly address this. What does he mean? Asset owners are the biggest beneficiaries of monetary policy. So what has monetary policy been recently in 2020 and 2021? Basically, what's happening with monetary policy is the Fed has been printing a lot of money and using it to stimulate the economy. And yes, this worked well. It did great. The money went into the economy and it helped it. But it also went to a lot of people who didn't necessarily need the money, so they put it into the stock market. If we take a look at what happened to the stock market over the past year, it's gone up by just over 90% in just over a year. So this is what he's meaning when he's saying that the monetary policy has benefited the stockholders.
I think a year ago, 2 years ago, I talked about we need a more fiscal stimulus and maybe less monetary stimulus. And so there is no question savers are being slammed, using your word. And that is a persistent problem, and that will remain a bigger problem. Much of this has to do with, this is one of the reasons why we're seeing many of the savers are now more confused. And I think some of them are now finally entering in equities and other asset categories as a part of it. I think, as you remember, on your show a number of years ago, I was asked, what should be your asset allocation? I've always said 100% in equities. Not that I predicted where monetary policy will be, but unquestionably, we are going to have to address what I would call the silent crisis of retirement. People are going to have to, unfortunately, whether they like it or not, they may have to work longer because they're not earning the same returns on their savings. On the other hand, if you had a balanced portfolio over the last year, you've done quite well. You may be being hurt on your bond or cash allocation, but in your equity allocation, you've done quite well. And for those who owned homes, obviously, they've been a big beneficiary.
So I just want to show you what he's talking about when he says that savers are getting slammed by the recent monetary policy. So let's look at the average savings account rates in 2021. And this isn't actually the average, this is the best. It's the best online savings accounts rates. So if we take a look at the absolute very best savings rate, you're going to get 0.5% on your money. The average, let's see what the average is. Average interest rate. The average, apparently, according to this website, is 0.06%. So if you save your money, you're going to get somewhere between that amount. Now let's look at inflation. Inflation, right now, it's almost 6%, maybe about 5.5% right now. So if you have your money in a bank account, you're going to get a 0.5% yield at best, or a 0.06% yield, and inflation is just going to kill the rest of that money. So on average, you're going to lose about 5% every year on your savings accounts. And this is what he's talking about when he's talking about a silent retirement crisis. Anyone who's invested conservatively and not put it in the stock market, which is taken off, they put it in the bank instead, their savings are getting eaten away into like nothing else. And yes, you may have to work an extra couple of years just to earn more money so that you can retire safely, all because of the high inflation that we're seeing recently and the incredibly low interest rates.